here today by a very special guest. Gene, how do I pronounce your last name? Tannuzzo?
Tannuzzo.
Wonderful.
Yep.
We are joined by Gene Tannuzzo, who is the head of fixed income at a giant firm. And we'd love if you could just tell us a little bit about yourself, a little bit about what you do day to day as we sit here and wait for the big announcement.
Sure. Thanks for having me. I'm really excited to join. Gene Tannuzzo. I'm the global head of fixed income here at Columbia Threadneedle. We manage about $250 billion of fixed income assets for clients globally. And what I really like about our platform is we're a global research organization. So whether it's the Fed meeting today or something related to corporate earnings or emerging markets, we've got boots on the ground around the world trying to figure out how we can find opportunities to make money with it. So thank you for having me.
That's awesome. No, we're so excited. And, as we head into 2 p.m. here, what I've been watching all day, it looks to me like people just seem to be kind of cleaning up positions. I mean, tell me if you feel differently. I know that PIMCO was very vocal about exiting their steepeners. And we had so many people who were positioned for a steepening out of the yield curve. Or I always get confused as to which way the screen is flipped.
That's the right way. Whatever you're doing now is correct, Jen.
Fabulous. So many people had been positioning for a steepening out of the yield curve, as we saw, obviously, expectations that rates in the front end would come down, and then people looking to what was happening with both, obviously, the fiscal policy situation here in America and the example led by Europe. But what we saw was instead a flattening of the yield curve, where bonds went from close to, call it 3% and rallied something like 40 basis points through the auction cycles, no less. So I think that surprised people a little bit. And I think that has a lot of people feeling like they're going to buy any kind of weakness today in rates. But I'm curious to get your thoughts.
Well, I think it's hard, anytime you're leading up in the days and hours before a central bank meeting to know exactly what's driving price action. But I think you summarized it really well. I think the market is accustomed to thinking about Fed policy. When the Fed is cutting, the yield curve should be steepening, plain and simple. And then the other factor that leans the same direction is fiscal policy. If there's large deficits, a lot of treasury supply, also steepening. And so that's played out, and that's been kind of the theme of the year. But I wouldn't get too carried away to say, oh, that has to be over, or that has to be done. I mean, we're looking at, as we sit here today heading into the meeting, the Fed funds rate as of this second is 4 3/8, and the 10-year treasury is not that much below that, right? So it's really a pretty flat yield curve. And I think if we're really getting into a cutting cycle, it could actually get a lot steeper.
Well, and by the way, I'm going to be like the dummy who's here because it's funny. Jen spent her the majority of her career in interest rate sales. I was more on like the corporate finance side. So, we were talking about how you obviously have the ability to actually look at Bloomberg and see it live. We do not have that ability. And so one thing that I think some of our listeners, especially because our audience does tend to skew a little bit younger, some people are really trying to, maybe they want to go into sales and trading. They want to start to learn about the markets. And so they're probably not going to have the tools. So I guess, Jen, what are you using right now to actually live stream what is happening? Do you have CNBC?
Yeah.
What are the live things that we're using to actually get the data and to react? Bloomberg, obviously, for you, Gene. But Jen, what are you using?
Yeah, so I'm a Bloomberg subscriber, so I have like the very limited Bloomberg Market Monitor app where I'm watching 2-year notes, I'm watching 5-year notes, I'm watching 10-year notes, I'm watching the long bond, I'm watching. Somebody just mentioned that they're watching where swaps are, USSW. So I'm looking at where the swap curve is trading as well, and what swap spreads are doing. I'm also looking at risk indices. So I'm looking at things like the S&P 500. I'm looking at the NASDAQ. I'm also looking at the Dixie. So I'm looking at the dollar index and trying to understand again, basic theory, right, is that easier monetary policy should lead to a weaker dollar. Tighter monetary policy should lead to a stronger dollar. The dollar has had a rough year. It hasn't been great. So I'm looking at all that on Bloomberg. I also am looking at CNBC. I like to have both up side by side because it kind of mimics, if you will, what the setup would look like on a trading floor with all the big TVs everywhere. And then I have the Fed's website open, and that's actually where their press release will appear. So if you're on the Fed's website, it's not necessarily the most navigable website in the world, but they actually have their press releases. And so you can go to their news and events and their press releases, and it'll populate there. If you're looking at
federalreserve.gov, is that the link?
Yes, federalreserve.gov. I was like, I don't know.
That in the chat.
Just type Fed, yeah.
just for those people who want to have that extra little like monitoring up and about. So
Exactly. No, that's a great call. So that's what I'm looking at as just a lay person until Bloomberg decides to grace us with a terminal one day, hopefully, from my list of God's ears. But Jean, in terms of what you think the most important
Sure.
things, metrics that you're watching today, what are you really paying attention to?
Well, I'm looking at a couple of things. I think one is it's less about this particular move, but really to see how much visual or obvious disagreement do we see, right?
Mm,
We saw two dissenters at the last meeting, and that doesn't include Governor Kugler, who left, and now we have maybe a more interesting or maybe controversial figure in her chair with Stephen Myron, right?
mhm.
So, I'd
Can
love
you-
to know what that first cup of coffee was like between, Myron and the rest of the Fed this morning or yesterday.
Yeah.
But truthfully, I think, if there's a ton of disagreement, that could really drive concern, depending on the nature of that around, Fed credibility in the longer run.
yeah.
I love
Can
that.
you,
And if
can
you
you,
guys see our eyes moving around, by the way, it's like 1:59. So
Yeah,
I'm like
yeah.
hitting refresh on everything. So normally we're locked in on the camera, but we're all monitoring a bunch of screens. Sorry, Kristen, go ahead.
and so just to be clear, because the press release goes live at 2:00 and then the conference is at 2:30. So you, Jen, had put up on our Instagram the last meeting's statement, because and you had put up, I thought, like a really fun little reel about comparing like the difference, because people will get that granular to look at like and it's 2:00. So you can go refresh your browser. But the differences between what was said in the last meeting and this meeting. And so we can see what exactly is going on. But let's see if anything has come in yet.
And truly on the trading floor, it would be like, and Jean, yell if you see something pop up that I missed. But on the trading floor, it would be like, and everyone starts moving and like the market starts reacting. And it's like the first person to lay eyes on it immediately does something and everyone's reacting. And then you see everyone being like, okay, so in that sentence, there was a period and now it's moved. I think it's going to be a little less granular than that this time around.
Seriously.
Yeah, and so it looks like we did get the 25 basis point cut that was, I think, largely expected, but we are seeing some more dissent, right? So
Mhm.
not surprisingly, we've got Myron dissenting in favor of a half point cut. I want to see who else dissented in here as well, but I think that, the market's kind of taken it in stride so far. I think if anything, if it looked like the front end of the Treasury curve was a little bit weaker this morning, as of 1 minute in, it's really kind of firmed up. So,
I mean, do you think that there's any hope that, or rather, do you think that too many market participants were holding out hope for 50 basis points?
I don't think so. It wasn't really in the price. It was definitely, we knew that opinion would get voiced at the meeting, but I don't think there was maybe a strong enough case. And the thing I come back to is, look, if you think about the transmission mechanism of monetary policy, financial conditions matter, and the stock market is at all-time highs.
Mhm.
And to make the case for what is otherwise considered an emergency move with the stock market at all-time highs, I suspect clearly it was raised as an option at the meeting, but I think it's hard to get that over the line.
Oh, I'm so glad so many of you are joining us, by the way. Okay, sorry, I'm just getting everything up here.
And so I put the link to what I assume is the press release. Like I said, I am like the dummy who this is my first time actually like really monitoring. Like I've never been like, ooh, I want to see what's happening live. So Jen has sort of been showing me like a little bit of the ropes. So here we have I put the link to the press release in the chat. And then I'm going to quickly take a look at what it says. And hold on, I'm going to actually find the one from last meeting as well, and I'll drop that in the chat too.
Now, it looks like we've got, so what are we looking at? 2 more cuts, right, for the rest of the year being penciled in? Or just one?
Yeah, and so that's a change, right? So
Yep.
if we look now at the summary of economic projections
Mhm.
in June, 3.9% was the end of year projection. Now they're at 3.6, right? So
Mhm.
they have taken that rate down. But interestingly, if you look at the same time, they didn't move their unemployment forecast higher. That stayed at 4.5, and they didn't move their inflation forecast lower. That stayed at 3. So this is basically saying with the same conditions, we just think rates should be lower. Now that's if you're just interpreting the numbers. If you're looking at the statement itself, it does read a little more concerned about growth in the labor market, right? So, if we look back to the July statement, they start out by saying, the labor market conditions remain solid. And if I look today, they are talking about economic activity moderated, job gains have slowed, unemployment has edged up. So if I kind of step back from that, it's the labor market concern and how that might change that's driving any anxiety here to want to cut.
Okay, so I have
And I'm just
September in there.
Oh yeah, and here, let's get the projections materials up there as well. Share. No, I don't want to put it on Twitter.
You don't even have an account.
I don't. Okay. And that's now in the chat as well. And I'm just reading through that.
Yeah, I wanted to see who the dissents were.
And the dot plot does look different.
It does look a little different.
But not as much as I would have expected.
But Myron is the only dissenter here as well. So
did you think that
he wanted the full 50 basis point cut versus the 25?
That's right.
Correct.
That's right. So remember last time, so Bowman and Waller both dissented, but they just wanted to cut in general because no one else wanted to cut.
Now they're happy, but they're not as extreme as Myron is.
I guess they're happy with a quarter point, and it gets into a little bit of the calculus of how much is one of them trying to run for a new job for next year.
Well, that's why I'm kind of surprised that Chris Waller wasn't higher, that he didn't dissent and also go for the half point as well. That's interesting.
Yeah.
And now, so as far as the initial market reaction, risk assets are happy. Risk assets are happy whether the sun shines or not. I mean, they seem to be happy just across the board. I thought that there was no way that a 25 basis point cut would spark more euphoria in risk assets. I'm kind of curious to get your take, Gene.
Well, I guess you have to think about what's going to really change the backdrop. And look, the Fed is saying that 3% is neutral. So that they didn't change that. Their longer run expectation on what is a neutral rate, which we could argue about forever, but they think it's the number 3, nice round number. And now they just say they're going to get there a little bit faster, right, than what they had previously projected. I think what we as a market need to digest is like, well, why are we getting there faster, right? Because there seems to be two parts of the debate that I imagine might be occurring within the Fed. There's the stream of the debate that says, hey, monetary policy was just wrong. It was too tight. Interest rates were too high. We should get there. We should get there sooner. And maybe we should do half a point now. I suspect that's the nature of the argument that you're hearing from Myron. On the other side, it's, well, no, the economy's not fine. And actually, if I look at the labor market, I've got some real things to be concerned about here. And it's a little bit of a playback of what we saw in 2024 that got the Fed going in the first place. But it's actually worse than that because if I look at payroll gains on a year over year basis, they're less than 1%. It's about 0.9%. And then if you look at some of those, what we call the benchmark revisions, where the BLS actually revised some of their stats, it might even be worse than that. We've never had in 50 years a labor market growing so slowly without having a recession like imminently, right? So there's a lot of reason to be concerned that this labor market weakness is more than just a soft patch. And if you're in that camp, then you should be cutting, but that's not necessarily a cutting that would be good for risk assets, to your point, Jen.
All right. And so Neha was asking to simplify a little bit. And so basically what we're trying to see is how much is the Fed cutting the Fed funds rate. And so big picture, the expectation, everyone going into this, I think there was like 100% probability of like a 25 basis point cut. That is what happened. And so we were looking at the FOMC statement, trying to see, how much did they cut by? They cut by 25 basis points. So that was expected. But there were some dissents, meaning, we had a whole episode, if you wanted to go back and listen, about just like how the FOMC works, like how the whole committee works, some of the politics that are kind of involved. And so as we're thinking about, we know that Jerome Powell is probably not going to be Fed chair come next May. So there are a number of Fed governors who are almost like auditioning to try to be Fed chair. So looking at some of the dissents, basically people who did not vote to do the 25 basis point rate cut, there was one, Miran, who just was actually sworn in yesterday. Sorry, Myron, who was sworn in yesterday. So he was nominated obviously by Trump, and again, the Senate confirmed him. He wanted to go for a 50 basis point rate cut. And so we're trying to see, okay, now that what was expected, the 25 basis point rate cut, what basically was the reason that all of these governors voted for the 25%? Why might we have seen Myron want to do 50%? Because there's these, potential issues in the labor market where we are looking at various statistics, like from the BLS, et cetera, et cetera. And so as we're doing this, we're also trying to see how is the market taking this? Like, what are risk assets? So like equities, like what's going on with, the various longer term rates, shorter term rates. So trying to kind of see just like big picture, how are people taking this? And so hopefully that kind of helps. So sorry, Jen, continue.
No, yeah. And we already got some other great questions here. People asking what caused those BLS revisions. We did a bit of a deep dive on this on our podcast as well. But as you remember, this data is all tabulated over a period of time and then seasonally adjusted. So these numbers come in, but it's not like every single company on one day is like, bam, here's my number. Like, here's how many people we hired and fired. And everyone who's filing for unemployment is like, I did it today. Let me announce it to the government, right? All of these things are being collected through a very laborious process. It then has to be adjusted. And those numbers continue to come in over time. So you get ongoing revisions throughout the course of the year, and then they do annual revisions as they clean the data from the prior year and seasonally adjust everything. So it's a very complex process. It's not like, oh, wait, I forgot to hit Shift F9 in the spreadsheet and I was missing something. Jean, anything you want to add there to my big summary?
No, that was very well described. And I think the element that is maybe unique right now in 2025 is that labor supply is changing in a way, like largely due to immigration policy, but also because sort of domestic population growth is not that robust, right? So there just aren't as many people to add to the labor force. And, you kind of think about one of two things is maybe happening. One is it's a pretty concerning growth environment. Maybe we're just losing workers. There would be lower demand from those employed workers. That's one potential concern. The other potential concern is what I consider like a Japanification. So if you look at Japan from the mid 90s to like 2015, there was like a 20-year period where it was like actually a slightly declining total amount of people employed in the country of Japan. And it was basically stagnation from an economic standpoint. So both of those things would be concerning. They wouldn't be, the objective of anyone's fiscal or monetary policy at this point. So I think we want to think about not just how the data are revised and trying to get the most accurate data, but what is it telling us? And is there a supply story on top of the demand side?
That was amazing, Jean. And I love the Japan perspective too, because so many of our listeners and young people who are getting into the industry now were born in the era of QE, right? And they don't understand that when we all came up, before QE was implemented in the United States, that we looked to Japan for the negative lessons of QE, right? And so we have been in this incredibly accommodative monetary policy pretty much like, since podcasts were invented, if you will, if not prior. And so the idea of, okay, well, we're going to need to ease again, but easing may not look like what easing has looked like in recent memory, where the Fed breaks out the bazooka and starts expanding its balance sheets, where it's just, hey, we're cutting 25 basis points. We're looking at the potential for a recession. Someone here asked about a soft landing, which we can get to. But somebody else before that asked, like, should I refinance my mortgage? And what I want to get to with that is basically, hey, listen, this easing of monetary policy, this is not the bazooka. This is, okay, we're taking the first steps toward acknowledging that things are feeling softer than we would like. And we are less concerned about the inflation side of our dual mandate at present. We are more concerned about risk to the growth side. What that means, though, is if you guys will recall, the Fed only with this target rate controls the very, very, very front end of the yield curve. What they don't control with that target rate explicitly is the 10-year note, off of which your likely 30-year fixed rate mortgage is priced. You're going to be priced at de facto some spread to that 10-year note yield. Therefore, if 10-year rates move, it's going to be because of future expectations for what the path of interest rates are like and a supply-demand dynamic shift in terms of where buyers are going out the curve in search of yield. It's not going to be impacted by Fed policy today, since they aren't doing some kind of quantitative easing. And unless I've read the statement incorrectly, they are still shrinking their balance sheet. So it's not like they have stopped the policy of quantitative tightening that they are doing. That's actually contributing to, if anything, all else being equal, higher yields in the long end. Again, not anything that they're doing. They're not all of a sudden like dumping treasuries into the market. They're just not buying anymore, and they're not reinvesting the maturing principal back in the market. So that was to the question about mortgages and what that means further out the curve. But so many more great questions coming in. Jean, anything I missed too? Like, guys, we are just, here to facilitate Jean's brilliance and try to break things down as simply as possible, since he's used to talking in very sophisticated terminology.
No, you summarized it really well. And I think, the mortgage question we often get, and that's been an interesting one the last 2 years, because mortgage rates have actually lagged this whole decline in interest rates, and they've stayed sticky and high. They've come down a little bit, but they're still really elevated. And folks who, got a mortgage anytime in the last 2 years are still kind of waiting for when it's worth their while to refinance. And one of the things is, that term structure of interest rates you talked about. The other thing is, like, just with interest rates having been so volatile, what is the extra risk premium that a mortgage investor wants to have over that? And that risk premium was so high, it just made mortgages really expensive. That started to come in, and we've started to hear some different, maybe some ideas about how policy could try to influence that. But certainly with, the Fed's policy of still shrinking its balance sheet, so-called QT, that's not going to help. Although I suspect, we're not that far away from them, I think, reinvesting the proceeds on their balance sheet.
Do you think that's the next move, if we get another 25 basis point cut, that they also eliminate QT altogether?
They might as well. I mean, you can get really cute, and there's a lot of Fed economists forecasting around what the appropriate level of the balance sheet is. And they talk about things like ample reserves. But truthfully, if you're cutting interest rates and shrinking the balance sheet, those policies are kind of going opposite directions. So I think they probably want to clean that up. And I suspect we're pretty close to that point.
So I was going to say, someone had a question. Who has authority at a large bank to make a big market moving trade during a Fed announcement? I would almost expand that too, to also like a asset manager. Depending, I mean, and here's the thing, right? It kind of depends on like what the asset manager is managing and what their mandate is. But I wonder, Jen or Jean, like if either of you guys can speak to just that question, which is...
I think let's start with Jean, because I think, operating from the standpoint of the bank, where we need to remember we are, right, as we are in the post-Volcker era. So you're not going to get the treasury desk or the swaps desk or the FX desk at insert giant bulge bracket bank here being like, all right, guys, like, let's go to town and let's buy, sell, put on a steepener, put on a flattener, et cetera, et cetera. It's going to be more so a reaction to what clients need to do. You're going to see that incoming flow from clients like Jean, who need to make asset allocation decisions in response to the market. And then it's the bank's job primarily as a market maker to facilitate that risk taking. Now, what they do with that risk when it comes in, if they go out and hedge all of it in the market, if they sponge it, like if they, basically if they decide to just wear that risk and let the position ride, all of those decisions can be made from anyone from an analyst level all the way to the head of a division. I mean, it really depends on the order of magnitude of the trade that comes in. But I think we need to backtrack and say, okay, well, the bank's primary responsibility is to facilitate the needs of its clients. And so why would, say, like a big asset allocator need to make a move on a day like today with new information that was maybe more unexpected? This seems to be a consensus outcome, but play devil's advocate, Jean.
Yeah, I think you summarized it really well. And the first point I would make is the U.S. Treasury market is probably the deepest and most liquid market in the world. So it's a pretty efficient market, right? Most of the, if not all of the available information is reflected in the price at any point in time. So it's sort of humbling, and it reminds me how much of a loser my kids think I am when, we're really excited about what happened today, and the 2-year Treasury yield moved by 0.02%. Right. So let's remember that, right? And I think in the background, though, the things that are moving that are really important because they're changing the structure of the economy. And as that changes, we want to think about what's going to create the best outcome and how we want to position portfolios with people's life savings, for God's sake. So like it is really important, but more so in the longer term. I think, people who are trading aggressively based on one particular decision here probably didn't have a particular edge based on this particular meeting or anything else. Or if they did, I'd like to meet them. But I think it's not so much that as much as there can be large flows, or there could be investors, probably not the banks themselves. I think about the banks more in the moving business than the storage business, right?
Yeah.
But on the storage side, the long-term investors, they can make shifts in their asset allocation, and they may just want to say, hey, let's wait for this Fed meeting to be over, and then I'll make the shift that I plan to make, whether I wanted to own more bonds or own fewer bonds. They can do that after the fact.
Oh, I love that. Okay, we've got a bunch of good questions here. And Gene, you just let us know when you need to hop. I know we're all going to be watching the press conference at 2:30. So I figured that would be the time to wrap this up.
Sure.
So somebody asked, RJ, I think, asked, given AI's impact on less labor needs, meaning that we're going to need fewer people to do jobs, do rate cuts, even for sure, still boost employment? Or could they just encourage more automation and CapEx spending that creates a cycle of even lower employment? I think this is such a fascinating question and speaks to the bigger philosophical question we have about the tools that the Fed has to affect its dual mandate and the transmission mechanism for that to the economy overall. I'm really curious to get your thoughts, Gene, before weighing in with my hot take or not.
I'd love to hear your hot take, but I would say quickly from my perspective, two things. One, I do think AI is an exciting technology, and we're seeing more of that hit the bond market from a debt perspective, because the CapEx build out for data centers and the hyperscalers is now requiring more than just what these semiconductor companies and tech companies could fund out of their earnings. And they're needing to borrow in a big way to really fund that build out. So it's interesting from that perspective. From an economic growth perspective and productivity in terms of to what the question is getting at, I actually think back to the Greenspan era in the 90s, when we were getting a lot of technological revolution with the internet, and we did see higher productivity, and that's good for growth. It also puts downward pressure on inflation. We get more for less a little bit, and that's sort of a good outcome. So lower interest rates, I think, look, the AI train has left the station. I don't think whether or not OpenAI is going to get a multiple $100 billion contract is dependent upon a 0.25% of interest rates. I really don't.
Right.
But I do think when you're talking now about more of the funding for that coming to the bond market, the cost of capital does matter.
I will say, I think it was last week, was it Oracle that had like a $300 billion contract?
I couldn't remember the number. That's the one. Yeah.
It was like, okay, like, do they even have, so anyway, yeah. And so Jen, what was your hot take?
No, I think that all makes a ton of sense. I am inclined to agree a little bit, but I think actually in the near term, it's funny. I think all the projections for AI replacing people, I think that is something that we're going to need to contend with in the long term. And I do kind of agree with the person who asked this question that I'm just not sure that interest rate cut is what makes or breaks that particular side of the equation. I think it is really also about wage inflation, right? And if we can get wage inflation to, like, that's the thing that people are looking for that hasn't kept pace with the rest of the inflation cycle as we get all of these different markers of inflation. And so I think what AI maybe is about, it's not about like creating or eliminating jobs just yet across the board. But I think it is in the near term actually like potentially causing a little bit of a spike before we see that deflationary outcome. And what it's doing is I think, continuing to keep a lid on wage inflation, which is the bigger problem, if you will, in terms of the Fed's transmission mechanism. And that's what I see as the bigger issue, not just like the sum total of jobs potentially being future. I don't think that's coming to pass just yet.
So the other question that I thought was good, and Jen, you mentioned it previously, but I'd love to hear your thoughts, Gene, is someone asked about sort of a soft landing. Are we still going to achieve it? And, 3 cuts they felt is really surprising. So curious your thoughts on just, soft landing.
I think the closest thing we could.
And sorry, wait, before we do that, can you define a soft landing for our listeners and viewers who may not know that term, who may not have been running in economics circles very often?
Yeah, thanks for saying that. Again, my cocktail party conversations might be a little more boring than others, but let's first define what a soft landing is not, right? Because often the Fed is cutting rates aggressively because there's a problem, right? There's a pandemic, there's a financial crisis, there's a recession. And in those environments, often the Fed is reducing interest rates by maybe 4 or 5%, right?
Mhm.
And so that's a period of demand destruction where people are losing their jobs, and it's bad, right? Soft landing is where the Fed preemptively reduces interest rates by a little and keeps the economy sailing. And I think the closest example to that is really last year, right? We saw a little bit of softness in the labor market. Unemployment didn't really go up. Fed took rates lower by 1%. Things seemed pretty stable for a little while. And I think, the best hope is that we get that again. And maybe we, buy ourselves a little bit of time when a little bit of the growth boost from the one big beautiful bill that's going to have a little bit of positive growth impulse here. Maybe that starts to come in around the end of the year, and then, we buy ourselves a little time for that, and it smooths it over and it's a soft landing.
So one question that I have before, somebody asked a very interesting question about SOFR Fed funds, which is a little bit more niched down than a lot of the conversations we've been having. But at the very beginning of the statement, I thought it was really interesting that the first big chunky revision that they had was eliminating all the conversation about tariffs effectively. And I think that that's an interesting change to the statement. If we think about that side by side, if I were to have like that red line version in front of me, I think it's pretty interesting that that was totally removed. Because if you have to think about what the entire talking point of everything that we've been discussing since April effectively has been, right? It's what are tariffs going to be? What's the export picture going to look like? What's the import picture going to look like? And what do you read anything into that of meaning? Is it potentially like the changing political makeup of the committee? Is it just, hey, listen, like we are not talking about that right now because we don't know? Like what do you think, if anything, there's something to read there?
I think there is something to read from it, but it's consistent with the research that the Fed's been publishing over the last 6 to 9 months, which is, okay, let's look at Powell's speech from Jackson Hole in August. He talked about his objectives being in conflict, meaning tariffs could push inflation up in the short run, but also unemployment rate maybe is going up at the same time. What do we do? And their research is actually very clear on this. Whether it's right or not, we'll see with time. But the research suggests that in that environment, with that sort of dichotomy, the Fed needs to treat tariffs like a tax. The Fed cannot control a tax. It's not driven by excess demand. Therefore, the Fed needs to look through it and focus on the weakness if it's in the labor market. And I think if they're dropping that, and that I'm just kind of pulling up the statement at, side by side as you say that, I think that's exactly what they're trying to do, is just shift the focus away from that because they can't control tariffs anyway.
And just to piggyback on what you said, I totally agree. And I think so many people in the public sphere have been calling for a monetary policy solution to a fiscal problem. And I think that the Fed almost was speaking to that in the last statement in a way that almost was unusual for a typical Fed statement. And I think it's almost back to business as usual with this one. And I wasn't sure if you were interpreting that as like now who's who on the committee, or, but
I wouldn't. I mean, the statement that jumps out now when you look at it is in the second paragraph. It says the committee judges downside risks to employment have risen.
Yeah.
And the best way to highlight that is drop the other stuff.
Yep. No, I think that makes a lot of sense. And then on the back of that, you referenced Jackson Hole. I had gone on here and spoken about the fact that I had a conspiracy theory that part of the reason that Powell turned so dovish at Jackson Hole was thinking about the precipitous drop potentially in bank reserves around Monday's tax deadline and now going into quarter end. And somebody on here said, from a borrowing perspective, what economic conditions caused SOFR Fed funds decoupling, and are there any potential spread arbitrage opportunities? So for our listeners who are like, what is this word salad? What do all these acronyms mean? So the Fed funds rate, right, is this rate right here that is set and maintained by the Fed effectively with the things in its toolkit. And SOFR is a reflection of overnight funding rates in the market for something called general collateral effectively. So the general collateral borrowing rate is where you can borrow money to fund levered longs through repurchase agreements for people who want to, say, buy treasuries and then post those treasuries as collateral for a loan, and reverse repurchase agreements where effectively you're doing the opposite, you're funding a short. So there has been a dislocation in the Fed funds SOFR market, with a lot of people talking about this potential funding stress stemming from bank reserves having dropped as the Fed shrinks its balance sheet. And there's been dislocation in that Fed funds SOFR market in spot and all the way out to, I think, 1 year's kind of periodically. We saw a massive blow up in 2019 with what we call the repocalypse. And then the Fed put the standing repo facility in place to prevent that from happening again in the extreme. We didn't get there. We didn't get the repocalypse when we came to the September 15th date, but we have seen dislocations. I think there was a print in GC of like 463 on Friday, I want to say, which, like, who knows, maybe it's a blip, but Fed funds SOFR has been a little bit more volatile, indicating that stress in the system. And I don't think that stress is gone simply because we didn't get a one-day switch flip. Are there spread arbitrage opportunities within there? I mean, all the big wirehouses are putting out research articles about how to play that in terms of buying and selling swap spreads. I think that's kind of beyond the scope of what we're talking here, but just what is your view, Jean, on kind of the funding situation and on front-end swap spreads, if any?
Yeah, if we are looking at front-end swap spreads, SOFR Fed funds, what we used to call the TED spread, which is the Treasury Euro dollar, or anything that used to have LIBOR in it, I put all of that into this bucket that I think of as money market plumbing. And when money market plumbing,
I'm going to use that.
Then when money market plumbing doesn't work, then the Fed is unable to transmit its policy the way it wants to, right? So is it a concern? I think it should be. It's not as concerning as some like 2019 or certainly like the GFC. Are there some opportunities? Yeah, on the margin, but you said a 460 rate in general collateral repo. That's an annualized rate, and so like the opportunity of that, over a overnight period is measured in fractions of basis points. It's real, and the people who are focused on that market take it seriously, as they should. I wouldn't view it as a panic moment or even an investment opportunity moment, as much as I would use it as a reason why the Fed should think about its balance sheet in totality and think that, yeah, they're probably closer to that ample reserves level and they probably don't need to shrink the balance sheet anymore. Simple as that.
Oh, I love that. I totally agree. And just to be clear, we are not giving investment advice here, guys. Like, we are, that is not the capacity.
An educational podcast.
Yeah, this is purely to understand, were an arbitrage opportunity to exist, what are the conditions that would bring it about, and how would you express that? So I think that was beautifully said and beautifully explained. We are at 2:30. The press conference is about to start, so I think we're going to wrap this up. Jean, it was such a pleasure getting you on here. We are so grateful. I know you're going to want to watch the press conference. Thank you so much for being part of one of our first initial YouTube lives. This is going to air as a full podcast episode, and I'd love to have you back on and learn more about you, learn more about what you guys do. I mean, you were absolutely brilliant. So thank you so much.
I really enjoyed it. Thanks so much. Thanks, Jen. Thanks, Kristen. This is really fun.
All right. Awesome. Have a great rest of the day. Bye, guys. Thanks